Welcome everyone to our YouTube live, and we'll be together for an hour. It's the usual format, so you fire questions at me and we'll try and answer as best we can. And I should say that if you do a super chat, then you get pushed to the front of the queue. Also, if you're one of our supporters on YouTube, you'll also get pushed to the front of the queue. And if you're not a supporter, you can become one. Just click on join underneath the screen, underneath the video screen for YouTube. And that way you can support us as well. It's very fairly priced, I think. And and then we'll see you're a supporter because there'll be a little crown next to your name. And Laura will flag you as being at the front of the queue. And you'll appear in this little document which I've got, which tells me if we've got a member question. So let's just start off with what's going on. Clearly in the UK, the big deal is that Boris Johnson is not going to be Prime Minister for much longer. The market's reaction has been fairly limited. Sterling rallied slightly, but it's still on a downward trajectory because of weak UK growth relative to the rest of developed markets, and also lower interest rates probably in the UK as a result of that. And probably the equity market maybe will get a little boost, but I don't think it'll be long lived, because really politics is kind of irrelevant unless it really does intrude on business and profits. But yeah, so far not much reaction. Globally, I think it's been 3 days now that we've had risk on in equity markets. The Nasdaq has been steadily climbing over that period of time, so is the S&P. So that's looking promising. I suspect it's not going to last, but we'll just have to wait and see. But the other video which we did this week, which seems to have gone down very well, is from Michael Burry. It's about Michael Burry, where he says that we're only halfway through the sell-off, because what he expects is going to happen is that earnings are going to get downgraded. The first half of the sell-off, he says, was just a re-rating, people paying less for the profits which are forecast. Now that the actual profits are going to be eaten away by high inflation, he thinks there'll be another leg downwards as the forecast earnings themselves fall. And if the price of the S&P is the forward earnings times the multiples come down already, and the earnings probably will come down as well. Because at the moment, brokers are still expecting very strong earnings growth in the United States. And this is at the same time that many people are expecting a recession. And in fact, if you try the latest Fed model on the probability of recession, as of today, the probability of a recession in the US over the next 12 months is over 70%. So not trivial. And that's because of high inflation, widening credit spreads. So the corporate bond market obviously is in a kind of fairly distressed state, not terribly distressed, quite distressed. And we've also got things like yield curve steepness, and the yield curve is inverted further. So, it looks as if we are going to get a recession. How deep it is, how long it is, nobody knows. But generally, that's bad for equity. So that could be another leg downward for equity if that comes to pass. We also got the Fed minutes today, and I think the thing which came out of it was that the Fed is really just debating two things: whether it goes into a restrictive monetary policy by the end of the year, so that would be a rate of between 3 and 3.5%, or a very restrictive monetary policy rate, so that would be 3.5 to 4 maybe. That seems to be the debate in the Federal Open Markets Committee at the moment. And of course, interest rates increasing is bad for growth stocks, as we've seen. So it just seems as if there are some things to worry about from here onwards towards the end of the year. And I think a lot of that hasn't been priced in fully to the equity market, which is now rallying, as we said. So anyway, let me now turn to your questions, and let's see if Laura's got anything for me here. No. Right, so let's start answering some questions. And the first one is from Ian B, who says, when is the stock market going back up? Can you please tell me? It's going back up right now, Ian. Yeah, I think look, if you are going to be investing for the long term, it kind of is irrelevant because you know it'll go up eventually. So really all you can say at the moment is you can buy equity cheaply, more cheaply than you could previously, and that's a good thing. And that's the way you should be thinking. If you ever need to make a forecast to invest, it's probably not going to work. So the only forecasts you can make reliably are that equity goes up long term. Over a 5-year period or less, nobody knows what's going to happen. So that's why I'd say, it doesn't really matter whether we know when the stock market's going back up exactly. What we do know is that eventually the stock market as a whole will go up. It's just a question of when. And that kind of is irrelevant. And if it goes up, if it takes longer to go up, it just reduces our annualized return. That's the only difference it makes. Okay, so the next question is from... Okay, so Oki Doi actually says, no one knows. Not even Ramin. Wink. Yeah, there we go. Bioinfo Musician. Good handle. In your excellent, as always, video with Joseph Hogue, thank you, he mentioned the opportunity to decrease risk by increasing our cash position. What amount percentage cash would you say is currently sensible? Well, look, if you're investing for the long term, then any money that's invested for more than 10 years usually should be almost all in equity, because equity outperforms bonds and bonds outperform cash long term. So that's why I think if equity markets fall, you shouldn't be selling equity to put it into cash, because that'll crystallize a loss and markets may reverse as they have this week, and you'll be left stranded in cash in a rising market. That's most likely what's going to happen. So that's why I think selling when markets crash is the worst thing you could possibly do. And it's something we always say, right? And what percentage cash would be sensible? Well, the only reason I'd keep cash is for stuff that you need over the next 5 years or less. So let's say you need emergency money for if you lose your job, or for repair of your house, or maybe an emergency, a medical emergency. So you have to build up a certain buffer in case these emergencies happen. And you have to keep that buffer in a very liquid form that you can spend really quickly. So putting it in property is not going to work because it takes a while to sell. If it's in cash, you can use it immediately. If it's in short-term government bonds, you can sell those immediately. But something which doesn't crash. Because what you don't want to happen, you don't control the timing of these emergencies, is you don't want it to have crashed when you need the money, because then you'd crystallize the loss. So that the kind of short-term stuff you'd put into something very safe, like cash or short-term government bonds or a money market fund, say. And then anything you're going to be putting away for a long period of time, more than a decade, equity. That usually is the best way to go. So how much in cash? Well, enough for the emergencies, your kind of safety buffer. Anything you'll need in less than 5 years almost certainly should be in low risk stuff, in low risk form. But longer term stuff, yeah, I'd say put the majority into equity. Even now, now that valuations are lower, it makes even more sense to buy. Niccolo says, howdy y'all. I'm afraid I can't say that, not with an American accent. Hisham Daoudi, nice to hear from you again, says, are European... Oh, here we go. Right, sorry, I scooted down too much. Are European long-term government correlated, I guess you're saying government bonds, correlated with the USA? Or would European long-term bonds have the same bounce that you're expecting like the USA, which you're hoping for in your fund portfolio? Yeah, so I did a video recently where I sold my commodity fund portfolio allocation, which has done incredibly well since I bought it. And the reason for that was that I think that we're entering a period of weak growth, if not recession. A reduction in demand for commodities is usually what you get with that. And remember that a lot of the boost in inflation that we've seen has come from commodity prices. Not all of it, but a lot of it, particularly energy. So if energy prices come down, which we've already started to see, by the way, in the last few days, then that's going to have a disinflationary effect on CPI inflation. So it'll push inflation, the rate of inflation, down. I don't think we'll get full deflation, but certainly a lower rate of inflation as a result of weaker activity. That's kind of how what the Fed's doing works, right? It's trying to reduce demand. And so if inflation comes down and growth is weaker, well, both of those are good for bonds. So that's why I thought I'd shift from commodities into long duration US Treasuries. So that's what I've done. But the question Hisham's asking is about the correlation between yields in developed markets. So let's have a quick look at that because it's kind of interesting. Now, normally what I look at is the US yields. So what I'll do is I'll show you a variety of yields here. So let's stick to developed markets, okay? So we'll start with the US. So we've got the US 10-year here. We've got the Italian 10-year, and we've got the German 10-year. And I'll go for the maximum period of time, and I'll add the UK as well. And maybe, well, let's stick with those for the time being, right? So immediately you can see that, yeah, they're correlated. When you get a kink in one curve, you get a kink in the others. So to first order, yeah, they're all driven by the same fundamental factor, which is, are we in a global recession? What's growth like globally? Sometimes growth is better in one region than another, in which case you'd expect the yields to be higher. But there's also a kind of credit risk for some countries, like Italy has a very high yield at the moment because there is always a risk that Italy will fragment from the rest of the Eurozone. And there is a kind of Italexit risk. I'm not sure what you'd call it. But yeah, for the UK, the 10 years 2.1, for Germany 1.3, for the US 3, just above 3, and Italy is 3.4. But you can generally see that they do move up and down together. So they are correlated, but the absolute levels you can see vary a lot. And in Japan, for example, it's always lower. Okay, so the Japanese 10-year here is probably the least correlated in developed markets, and it's always, not always, but usually much lower than other regions. That's partially to do with growth, but it's also yield curve control from the Bank of Japan. So it's actually limiting how high those yields can go. And it has unlimited firepower to protect that yield. So there we go. That's the story with yield. And yes, it is largely correlated across developed markets. So let me just switch back to the questions. So if yields go up in the US, will they go up in Europe? Yeah. And if yields go down in the US, will they go down in Europe? Probably as well. Yeah. And that's because if you get weak US growth, probably that kind of environment is one in which you get weak growth elsewhere as well. So if you're going to buy, but the absolute level of government bond yields matters as well, because the income you receive due to the coupons, but also due to the mark-to-market changes, is to first order the yield on the bond. So the yield is roughly the rate at which you make money on a bond fund or a bond. So if it's a higher yield, you'll get a bigger income. So would I be buying bunds right now or Japanese government bonds? No, because the coupons on those are lousy. Whereas for the US 10-year, you'd get more than 3%. And gradually over time, what's going to happen is as more bonds are issued, then they'll pick up this higher coupon and the income will gradually increase on bond funds, government bond funds. So, yeah, I wouldn't have gone for European government bonds. I did go for the US Treasuries for that reason. And I went for it unhedged because sterling is weakening, and that actually flatters the value of the fund. if sterling weakens versus the dollar. So thanks to Boris Johnson today, I actually lost a little bit of money. There we go. Next question is, let me just check my, no, nothing from members, okay. From Konstantinos Prosapoulos, who says, is there any scenario in which high inflation helps highly indebted EU countries, assuming their GDP keeps up? Well, I think this idea that governments want to deflate or inflate away debt is a false one, because in the kind of environment where it would make a material difference to the amount of debt outstanding, inflation would have to be so high that it would also have a really negative effect on the economy. And here I'm thinking about, inflation above where we are today. This is like 15%, something like that. The only consistent way to grow, to get rid of debt is to grow out of it. So to have GDP to be greater than the rate of growth of your debt. So most countries can manage that. In order for it not to happen, either growth would have to be weak, or the amount of debt outstanding would have to be increasing very rapidly, because the government's issuing huge amounts of debt and not stopping doing that. But that's not what we're seeing in the US right now. They've had very high tax receipts over the last couple of quarters, and there's actually a shortage of short-dated US treasuries. For example, T-bills are running short because the Treasury is actually issuing more long-term debt to lock in these low rates. So I think the idea that you could kind of inflate away the debt is a false one, because it would crash the economy. Nobody wants to do that. So I don't think it's going to help a lot in any way. The only upside I can see to inflation is that it does tend to reduce wealth inequality. And usually people who have the greatest amount of wealth would be the ones that would suffer most from high inflation. Of course, income is a separate story to wealth. Wealth is the kind of accumulated amount of capital you've got. Income is the rate at which you acquire new capital. So in terms of income, poor people usually suffer from high inflation. But in terms of wealth disparity, periods of high inflation actually reduce the wealth inequality, which is a benefit, I think. But other than that, it's very hard to see positives with high inflation. It's really a lose-lose for everybody. So the next question is from Randeep, who says, has the US avoided recession when the chance has previously been 70%? No, in a word. If you actually look at the graph of the model which I'm talking about, it's by Kylie. Let me see if I can pull it up just quickly. And let's see if I can get the nice graph he's got. Oh yeah, here we go. So this is the video I made. This is what I made my video about. So firstly, he points out, it's a very well-known result. This is where the SARM rule comes from, that if unemployment's going up very quickly, that's when you get a US recession. And that works for every single recession going back for many, many decades. So what he actually tries to do is identify those periods when unemployment is above its, I think it's the 80th percentile. And that's what you can see with this, these kind of dashed boxes. These are the periods when the change in unemployment rate over 4 quarters is above its 80th percentile, which is pretty much a recession. It's like a now indicator of a recession. And that's how Claudia's SARM rule works. Now, when it's above 70%, it's very unusual not to have a recession after that. You can see here it reached just under 60%, and here just under 60%, but here it was above 80 and there was a recession. Here it was about 50 and there was still a recession. And more recently in 2020 it forecast the pandemic. Okay, so that's what this model does, and currently it's flashing 70%. So yeah, so I'm pretty concerned that this thing is going to. So it was when this was published, it was about 50. Currently, it's about 70. And if you're a member of our community, you get access to that model, so you can get the latest probabilities. So no is the answer to your question. So it's not looking good, I'm afraid. What it doesn't tell you is how big the recession is going to be or how deep. That could be not so bad, which would be a good thing. Next question is from Ofair Elrom, who says, can the real money supply, nominal divided by inflation, go down even if restrictive policy is over? That is in case real inflation is in a higher place. Well, the thing is, most of the new money which is created is not created by the central banks. It's created by commercial banks when they make loans. That's where most money comes from, because that literally comes out of nowhere, as does the Fed's printing machine, right? They can create money out of nowhere. But usually most money comes out of banks. And if banks are lending and companies need the money from banks, then the money supply will increase as well. So, but your question is, can the real money supply go down even if restrictive policy is over? I guess what you're talking about is fiscal policy, maybe? Because the point is that when the government is being really generous and spending a lot, it can plug the gap between its income via taxes and its outgoings, which is its government expenditure, with debt, by increasing the amount of debt, issuing US treasuries in the case of the US. So if fiscal policy is very generous, then that's when you increase the amounts of bonds in circulation. And then the Fed's been buying them as part of its QE program and generating new money to do that. So a lot of the new money, some of the new money which is being created, was as part of QE. Now the Federal Reserve is shrinking the size of its balance sheet. And so we can look at the size of that. And it was 9 trillion. And it's not much smaller now, I've got to say. It's pretty hard to see how much it's shrunk. Let me just show you that quickly. So this is the Fed's balance sheet. These are the various QE programs making it get bigger. It was just kind of touching 9 trillion recently. Now, in theory, quantitative tightening has already started. But as of June the 29th, which is the last time we got data, the actual outstanding size of the balance sheet for the Fed was 8.9 trillion. And I think it peaked at 8.965. And on last Wednesday, it was 8.913. So it is shrinking a bit, but not much. So is it much tighter in the sense that the size of the balance sheet shrunk a lot? No, it isn't. So it's going to take a while for this stuff for quantitative tightening to happen. But I guess, if we think about money supply, let's look at M2. M2 money supply. This is real M2 money stock. That is also starting to come down a bit. So that peaked at 7.6 trillion, I guess. And that has started to fall a bit. So, yeah, it is falling a bit. But really, I think the importance of money supply is limited. It doesn't really predict a lot. It doesn't affect markets a huge amount. A lot of people are saying that markets rallied hugely because of the increasing supply of money. I'm not convinced that's true. if you look at the rise in the US equity market, it's pretty much been matched by corporate earnings. You could say that corporate earnings themselves have been stimulated by more money sloshing around in the economy, maybe. But you've also got other examples where money supply has increased hugely, but the stock market hasn't. Take Japan, for example. There you find the debt to GDP is like 200%, whereas in the US it's much smaller, 120%, something like that. So why is it that the Japanese market hasn't done the same thing? And why is it that Japanese inflation is just around 2%, So it doesn't really create inflation. It doesn't predict much money supply. So I don't really pay it that much attention, to be honest. People who are kind of obsessed with inflation, gold bugs, tend to talk about it a lot. Cryptocurrency enthusiasts as well, but I'm not convinced that it's very predictive or very helpful to investors. There are other macroeconomic variables which are much more important. Things like credit spread, things like unemployment, things like inflation. That's much more worth your time as an investor than money supply. So I hope that's kind of answered your question, Konstantinos. Offer, sorry, it was Offer Elron. Question from Randeep. What will the UK need to realistically do to avoid the pound devaluing further? Well, a large driver of devaluation of sterling has been weak growth. So anything that could potentially increase UK growth would be very helpful. Now, obviously we have to contend with Brexit because exports have suffered as a result of Brexit. About half of our exports were to the European Union, and we now have a self-imposed transaction tax and paperwork and trade friction with half of our exports. And that's inevitably going to be a drag on growth. So that's a problem. We also have disrupted our own supply chain because a lot of our foods and parts for cars, for example, were coming from Europe. And again, we've made that more difficult with Brexit. So, the combination of the pandemic with the supply chain disruption due to Brexit and a general lack of productivity growth in the UK for a long period of time have been responsible for low growth. What can we do about it? Well, the usual prescription for increasing growth would be to spend on things like education, because if that happens, then usually people become more productive if they've got better paid jobs. And can that happen to a whole society? Maybe not everyone, but to a large proportion of society, yeah. I mean, just look at what China's doing. Also, another thing you can spend on is infrastructure. That's what people always say. So better broadband so that people can work remotely from all over the country rather than a few places where they have fast broadband. And I'm particularly bitter about that because I live in Buckinghamshire and the more rural parts of Buckinghamshire have very poor broadband. So yeah, I just think that having that kind of infrastructure is more productive. Better roads, better communications networks, better transport so that it's easier to move from A to B and less time consuming so people can do more stuff which actually makes money. All of those things I think would be good for growth. But I don't really see much sign that the government's really committed to many of those. They seem to be much more, at least the current government in the UK seems to be much more keen on reducing spending. That's just in the DNA of their party. And if you do that, clearly you don't have money for education, you don't have money for infrastructure. So it's not really clear where the stimulus is going to come from. So, we have to contend with the supply chain disruption. We have to contend with Brexit and the difficulties that's imposed with our trading partners. And it takes a long time to create new trading relationships, as we're now learning. So I think all of these are kind of problematic, but clearly something needs to be done to kind of stimulate UK growth and productivity, because it has been the worst. I think it's the last 3 or 4 years have just been atrocious for UK wages in real terms. And previously, before that, over the last decade, there's been almost no real wage growth in the UK at all. So we're not getting any wealthier in the UK. So I think those are the problems. And, education, infrastructure are the usual solutions. I'm not convinced this government has got what it takes to do those things. So, yeah, I'm not very optimistic about the UK. So I'm kind of glad I'm not hedged on my sterling position with US Treasuries. Anyway, those are the usual prescriptions. The next question is from... Oh, we've got some members. That's great. Oh, yes. So Laura's made a note in the document, which I'm reading, which says, share the live stream and like it. So please do subscribe to us if you haven't already. Share it with your friends. Put it on Twitter, Instagram, whatever it is you use as social media. Tell people about it. That would be great for us. Even if you're watching it in replay, that's fine. And obviously like it, because other people will know about it if you do that. And the next question is actually from one of our supporters, one of our regular listeners, watchers, Stephen J. Nice to see you, Stephen J. Thank you for supporting us. You say, what do you think about long duration euro bonds like IBGL? If the situation in Europe gets worse, Kaliningrad, Ukraine, no gas, nuclear, the bonds would go up compared to long duration USA bonds. So let's have a look at IBGL. It sounds like an iShares one. Okay, yes it is. So this is a Euro government bond fund. And so this is 15 to 30 years. So the duration of this puppy's pretty big. So it's very sensitive to European interest rates. And another interesting thing will be to look at its duration. So the effective duration of this fund is very big, about 17 years. So long duration would be anything more than 10, right? So 17 is very long duration. So this is very sensitive to European yield curves. And if we look at the weighted average coupon, it's only 2.5%. So what I suspect is it's got a lot of German debt in it. So let's have a look at the holdings just to see what's in it. And so about a third of it is French bonds, a quarter is Italian, and a quarter is German bonds, Spanish bonds 14, and Dutch bonds 8. So if that's the case, then the French stuff is going to have a pretty low yield. The Italian stuff will have a fairly chunky yield, about 3.4% is what we saw earlier for 10-year. German, almost zero. Let's have a look at German yields, actually, just quickly. Yeah, let's have a look at the German yield at the moment. So German 10-year is 1.3, so that's not great. And Spanish is not there. Spain. Spanish 10-year is 2.4. So the Italian stuff is giving it the real juice in terms of income. That's 3.4 or 3.65 for the 30-year. So that's the way I'd look at that's how I'd read the term sheet. So currently the yield is pretty good for a European government bond ETF. The expense ratio for this thing is 0.2, so not too high. That's good. And yeah, so I think that's kind of interesting. But yeah, if there was an absolute disaster in terms of growth, which is looking pretty likely, I was just looking at tweets today from Germany where the cost of energy has just gone through the roof because they got rid of all their nuclear power except for 3 plants, and they're very dependent on gas. And if that gas thing gets shut down, we're in real trouble, or at least Germany's in big trouble. So yeah, if that was to happen, if there was a kind of economic deep recession, it would be great for European government bonds. So the same argument applies as it does for the US. So I think, yeah, I think that could be an interesting thing to do right now. Certainly the equity situation won't be great in Europe if all of that comes to pass. I hope that helps. Next question is from... Oh, I guess also, Stephen, you were talking about relative to US bonds. Yeah, I mean, if the situation was much worse in Europe in terms of growth than the US, then yeah, I'd expect the bonds here to rally more. And now that yields have gone up a bit, they've got more room to fall. So I think, you know, there's potentially more upside. And the risk reward is now much more attractive, even in Europe. Next question is... Oh, it's a super chat. Thank you. Interesting name. Pooping while standing. I like that. Thoughts on commodity futures like UNG, USO, VCMDX? Well, let's have a look at USO right now. And why don't we do it on Coifin? So certainly over the last few days, energy prices have been falling very rapidly. So this is the USO fund, which gives exposure to a variety of energy commodities. And you can see it did very well coming out of the point at which energy fell to negative numbers in April of 2020. And it's been storming upwards ever since. The turning point was roughly mid-June, I'd say. And since then, it's been pretty bad. So it hasn't fallen by a huge amount, but it's, you know, let's see how much it's come off the top. This is down by about 17%, which even for oil, which is very volatile, is still pretty chunky, with some big falls over the last 3 days or so. So do I think that's going to be a trend from now onwards? Yeah, probably, because of this weak growth thing. So if growth is weak, that reduces demand for energy, and usually energy prices come down. So I think the fact that Russia has reduced the global supply, that story is pretty much priced in. So now people are turning more to the demand side. And if there is weak growth in the US, the US is a big user of energy products, fossil fuels. So that has a big effect on energy prices if US growth is weak. So I'd expect that to be a pretty bad story for US commodities. Let's look at some of the others you mentioned. So UNG is another one. So UNG, that's natural gas. That I suspect has recently had a spike because there is a threat that they're going to close down supplies from Russia. So that has gone up a lot over the last few days. But also from the top, that's down quite a lot. So how much is that? That's looking comparable actually. So that's down by about 38% from the top. So I think a lot of the kind of upwards impetus that came from the supply disruption is kind of accepted now, and people are turning more to the demand. So I think that'll apply to natural gas as well. So, you know, if you go for a kind of diversified commodity fund like VCMDX as well, which I think is more diversified. That's the Vanguard one, isn't it? Commodity strategy fund. Yeah, again, you know, it's certainly tanked recently. And this is why I bought my commodity. That's why I sold my commodity exposure recently. I just think this is a trend that will continue. So yeah, personally, I'd keep away from those now. And I'd go for government bonds because I just think in this new environment of weaker growth, if it comes to pass, that'll probably be a better allocation. But that's for my fund portfolio, I should say. For my core portfolio, I've just carried on drip feeding into equity. It's not a good idea to de-risk when markets are cheap. In fact, you should be doing the opposite, right? So that's just my fund portfolio. So back to your questions. Another swig of fizzy pop. And I'll come back to your questions. Right. Next question is from Antonio Penado Leon, who says, "Hi Ramin, time for utilities to shine." Well, yeah, I mean, utilities are defensives, so they never really shine. They just don't crash as much as the rest of the market. And maybe that's the best we can hope for in this kind of environment. They'd also have a kind of value tilt because, you know, those are the stocks which are probably undervalued right now. So, yeah, I think they'd be defensive. And another defensive sector would be healthcare, or consumer staples would be another kind of sector which is quite conservative and also quite defensive in these kind of recessions. Usually those are the sectors which lose least, and cyclicals would be the ones which would move the most and lose the most. So I think, yeah, utilities might be something to consider. It was interesting talking to Joseph Hogue. He was saying that he thought that growth would actually be a good investment right now, whereas I think that probably, you know, growth in this kind of higher interest rate environment where the kind of easy capital is not easy to come by anymore, and also credit spreads are widening, so funding costs are increasing. I just don't think that's a great environment for growth. You know, maybe once we come over this kind of difficulty and risk appetite, you know, this difficult period, maybe then, you know, growth will be more attractive because the valuations will probably come down further. And yeah, maybe we'll go back to a little rally in growth. But personally now, at the moment, my tilt would be more towards defensives if I did that kind of tilt, which I don't usually do. And utilities, yeah, probably. Next question is from Joel doing Joel things. Do you think central banks are using the reverse wealth effect to curb inflation without increasing rates above the rate of inflation? Yeah, okay, so the wealth effect, if people don't know, is if you've got a house which is very valuable, then it makes you feel more wealthy, and that apparently makes people more likely to spend. And if that happens, that's good for corporate earnings, it's good for US growth. So at the moment, the Federal Reserve is clearly raising interest rates, so that reduces the leverage that people can have in the property market and usually reduces the rate of property growth. And that does seem to be what we're seeing in the US right now. If you look at the Case-Shiller indices, they're still going up last time they were published. But anecdotally, I can just see on Twitter people who talk about this, real estate prices are starting to slow down, particularly on the West Coast, not so much on the East Coast. But I guess it's just a matter of time. So with mortgage rates being higher, inflation being higher, and real wage growth falling, that suggests that house prices can't carry on rising at their current rates. So that reverse wealth effect, as house prices slow down or even go into reverse, I suspect that would be quite effective in reducing demand. And that's what the Fed's trying to do, and also stop people spending, right? That's what it's trying to do. So I think that could be one channel by which their monetary policy operates. Another one would be to reduce demand for labour, because if there is weaker growth, then there's a very tight labour market right now. What they're trying to do is to reduce demand via the credit channels as well. So if it's more expensive to have a mortgage, but also things like credit card debt would be more expensive. Other types of loan would also be more expensive for people. So that'll reduce your income, and you know that should slow down the economy. So reverse wealth effect, yeah, maybe that's one of their plans, but that's just one channel. What they don't want to do is to crash the property market completely, because it's a large store of wealth for US citizens. So that's clearly not on their agenda. But to reduce the rate of house price growth, yeah, I think that's true. Because if you look at price to income ratios right now in the US and in the UK, they're higher than they were in 2006, just before all the unpleasantness kicked off, the last time we had a fall in house prices, and of course the global financial crisis, although that's not going to happen again, I don't think. Right, 15 minutes to go, and let's just see if yes, there's another question from a supporter. Thank you, Jack. So Jack Lemasson, who says, thank you for supporting us, Jack. Several analysts forecast a harder recession in Europe than the USA. Why would that be? And what do you think? Should my 30% exposure to Europe go down? Oh, wow, that is punchy. So market cap weighting, you'd expect maybe 10% allocation to Europe, 10, 12, something like that. So you have roughly a twofold or threefold overweight for Europe. I guess that's because Europe's cheaper is what I'm guessing is the justification for that. So let's just think about the situation in Europe right now. And let's have a quick look at the PMI indices for Europe, particularly Germany, because Germany's kind of like the beating heart of Europe in terms of its manufacturing ability. Let's just see if I can find the PMI. PMI press release. Here we go. No. Yeah, here we go. Eurozone PMI. And this was... Let me just check the date on this. Here we go. So let me just share my screen with you. This is always a good read, by the way. If you're ever kind of interested in what's going on in the economy, just go to PMISPglobal.com, public release press releases, that's the URL, and have a look for the country of interest, which in this case is the Eurozone. And let's go for Germany. Germany. That's a construction PMI, so I don't want that. Germany. Let's look at the German manufacturing PMI. So this was on July the 1st. So as you can see, it's kind of just from the headline, manufacturing outlook darkens as a sharp fall in demand for goods weighs on factory output. So this is literally the beating heart of Europe. This is where all the exciting cars which are manufactured in Europe, a lot of them come from. And, you know, it's just like reading like a litany of bad news. But if we fall below 50, that's usually a situation of contraction. Above 50 suggests expansion. That's how the PMI indices work. And we're still above 50, at least we were when this was published. But you can see it's falling very rapidly after the kind of post-pandemic bump. And if you actually read the small print, it's the new orders which is the really worrying thing. Because once new orders start to fall, and if you have lots of inventory and not many new orders, then that suggests that you're kind of going into a slump. And there has been a decline in new orders and multiple headwinds to export sales. So they're talking about some relief on the inflation front, but if you actually look at the latest news about what's going on with the gas supply and also the expense of, oh dear, I've switched to Boris, sorry about that. And if you look at the expense of electricity, for example, the cost of electricity in Europe, the price is looking almost vertical. Now, how can those companies manufacture cars when their input cost, which is energy, one of them, has just gone, you know, through the roof? It's going to make them much less profitable. So I think that's a big worry. And if I had a big exposure to Europe, that would be a big concern. Energy security is just a policy which hasn't been sorted out at all. It's just been like a festering sore in monetary in kind of government policy in Europe, which people have kind of swept under the carpet, but now we're really starting to see the problems with it. And I'd be really worried about my exposure to Europe. So personally, I think that the exposure you've got is probably too high, and I'd probably cut it. I mean, it's not a problem if you switch from one equity to another. You wouldn't be selling for cash. You'd just be switching your allocation to be more in line with market cap. But would I be bullish on Europe at this point? Probably not. So yeah, keep an eye on the PMI indices and also on that energy supply issue, because I think that's going to be a big driver downwards for European equity if that really does start to bite. And it's looking like it probably will. Next question, also from one of our supporters. Thank you, AG Smith. And he says, joining late. Never mind. Has anyone asked about triple B and high yield mixed duration assets? Not yet. And we can have a look. We can have a look at the spreads. So this is always another good thing to watch as an investor, is to look at what's happening to spreads. So credit spreads tell you how much additional income corporate bond investors are paid for taking credit risk. And implicitly, it prices in the probability of default. So if you're going into a recession, then corporate earnings fall. Companies with weak balance sheets, which can't really afford their debt very easily, will start to be tipped over into bankruptcy. So we'd expect to see the default rate, which is currently very low, increase, and credit spreads have widened to kind of compensate for that. So let me just show you this. So this is credit spreads for Europe. Sorry, this is credit spreads for the US and for different credit ratings. So the tightest credit spread would be for the highest credit quality. So in this case, that's AAA. But notice how the single B has just shot upwards. So the credit spread on that is currently 6.5%. At the height of the sell-off in the pandemic, it reached 9.6. So it's increased a lot, and it seems to still be increasing. Another way to measure distress in that market is to look at some of the junk bond ETFs, so HYG. And you can see that that's been on a fairly steady downward trajectory. So yeah, there's really been very little comfort in that market. So how much has it fallen? So HYG, the junk bond fund in the US, is down by about, oh no, just click on that percentage thing again. And that's down by about 20% since its peak, maybe a bit more. So clearly the US markets, certainly the high yield market, is down by 16% off the highs. So credit spreads widening is not good news for a lot of US companies, because if funding costs are higher, then some companies are going to go bankrupt. Some companies will just not be able to roll their debt over so cheaply. This will erode their bottom line, so they'll become less profitable. So generally it's a bad story. And that's why credit is really interesting usually, because it leads the equity market usually by around 5-6 months. So this credit spread widening is just bad news for the equity market as well. So that's the one that you really want to keep an eye on. And there hasn't been much of an increase recently. So yeah, it has rallied a little bit today along with other risky assets, but not a lot. So I'd be concerned about that. So no, I don't think anyone else asked that, and it is an interesting question. Okay, so actually Jacques Lemasson actually came back. He says it's 30% global, mainly Europe, and 70% North America. And you say you're based in Canada. Oh, okay, so 30% global, I guess you mean non-North America, of which a lot of that will be in Europe and Japan. They're roughly the same size by market cap. I think Europe is a little bit bigger than Japan in terms of market cap. So yeah, I think I probably reduce my non-North America weighting. Anyway, whatever is market cap weighted, I probably bring it back into line with that. That's probably good enough for the time being. So let's go back to your questions. So keep an eye on those spreads. You can see them updated almost daily on Fred, and it's a pretty good indicator of what's going to happen with equity as well. It's unusual to have credit selling off a lot with equity doing really well. And in fact, one of the inputs to that Kiley recession model is credit spreads for BAA credit ratings. Right, next question is, I've got time for a couple more maybe, so I'll be very selective here. I'd like to invest in the MSCI World ETF, but I'm concerned because I earn in euro and now the dollar is very strong. What are your thoughts on this? Well, remember that every euro you put into that index in euros will then get converted into dollars. And if the euro carries on weakening versus the dollar, that's good for you. Of course, for every new euro that you put in, it's getting more expensive. So that's the drawback. But for the stuff you've already put in, it's good news. And if you do put in a euro now and it carries on the trend of euro weakening versus the dollar, again, that'll carry on being good for you. But generally, look, currency over the long term probably doesn't matter as much as equity returns. So if this is money you're going to put in there for 10 years, 20 years, 30 years, then you can effectively ignore currency movements. And because remember that usually what happens is that currencies snap back into line with each other once interest rates and growth come back roughly into line with each other. At the moment, there's a kind of dislocation because the growth in the US is seen to be better than the rest of the world, and that means interest rates are higher and the dollar's stronger. And when people are scared during an equity market sell-off, again, that tends to strengthen the dollar. But all of these are temporary things, and I suspect that the dollar, once things go back to normal, will start to weaken again versus other currencies. So if you are investing for the long term, and if you're listening to me, you probably are, then don't worry too much about the currency. It'll all average out in the end. The equity returns effectively allow you to ignore currency over the long term. Next question, last question, is from Christian Tirelli. Interesting question. Do moving average trading strategies actually work? A lot of people say it's better than just doing buy and hold. Is it true? Well, over the long term, no. Over the long term, what you'll see is that any of the alpha that's generated by using moving average trading probably won't help. There are periods in which it does help. So let's say you've got a very steady downward trend. Well, if that's the case, then you'll be locked out of the market because, you won't be investing during that downward trend because the short-term moving average will be below the long-term. So that'll stop you out of adding more to equity. But the problem comes when you've got a kind of volatile period, when you're just kind of whipsawing up and down like you are now, because there's no kind of clear momentum trend. And it's just a matter of luck as to whether the momentum signal gets you into the market during the same time that you've got a rally, because the rally doesn't persist and you may kind of whipsaw down just as you put money in. And in an up market, which is what happens most of the time, well, you'd be buying anyway. So that's why over the long term, it doesn't make a lot of difference because the default for equity is to move up. So I'm not convinced that these strategies work well. So, I'd probably avoid it, but, that's just The other point, I guess, is it's just a lot of effort to try and monitor what's going on with momentum. And it's much simpler simply just to drip feed into markets. And I don't think there's a lot of alpha from these momentum strategies. Not enough to warrant the extra work involved to kind of do your allocations. It's much easier just to drip feed in without thinking. And usually that performs very well anyway. That's what I like about investing. It's kind of the environment where being smart doesn't make any difference. Being factually based makes a big difference. So looking at what works, but putting in extra effort often doesn't pay off. And I think this is an example of that. Anyway, I think we're at time now. So don't forget to like us. Don't forget to subscribe to our channel. Don't forget to join our membership, because then you get one of these sessions which is just for members, and you get lots of members only content. You get access to Slack, and we can talk about markets whenever you like, rather than every month. So thank you all for joining us. It's been great to have you with us for an hour, and I hope your journey in the markets is a good one. I hope it's another good month for you, if it has been a good month. And let's hope that this sell-off starts to ease, at least for now. And but the thing to remember, keep allocating to equity. Don't sell in a market crash. Keep to the plan, which is a long-term investment plan, and keep it diversified. And that usually is what works best for most people. And I hope to speak to you again in a month's time. So have a great month, everyone, and we'll speak again in August. Take care. Bye-bye.